Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Ken Gee. Ken is the founder and managing member of KRI Partners, a real estate private equity and investor education firm. He has more than 26 years in real estate, banking, private equity, and real estate investing experience. Throughout his career, he has been involved in transactions valuing more than $2 million, which has included the acquisition and management of financing various multifamily real estate projects. Prior to some of that, he also used to own several Cessna pilot centers where they trained some of the Connection Delta program pilots. So, Ken, I am looking forward to hearing about your story, and welcome to The Wealth Flow.
Well, thanks so much for having me. I'm looking forward to it.
Absolutely. I like to typically just start with your background, what eventually led you to real estate, but where did you grow up, and what are some of the other things that you've done prior to getting into the multifamily world?
Yeah, so I grew up in Toledo, Ohio. Most people don't even know where that is unless you watched MASH, and Max Klinger was from Toledo, and Tony Pacco reference. So grew up there. Got my undergrad from the University of Toledo in finance. That prepared me to be a commercial lender. So I moved to Cleveland, became a commercial lender. I spent 5 years as a commercial lender, talked to all my clients about, hey, I think you should do this. I think you should do that. And they're like, you know what? Let me ask my CPA. I said, oh, okay. I said, well, what? Okay. All right. Well, I wanted to be that guy. I wanted to be able to help people. So I said, all right, I'm going to go be a CPA. So I did. I pursued that master's degree at Case Western Reserve in Cleveland, and then went to work for Deloitte, where I spent 7 years there on the tax side. Did a lot of, as fun and stuff as you can do as a CPA, a lot of merger and acquisition work, a lot of private equity work, tax planning. It was a really cool experience. It now, fast forward, it served me extremely well. But it was there that I really decided that I wanted to do real estate. And it was kind of weird the way this happened. So my kids were young, right? Remember, this is 25, 26 years ago. I would do my daughter's feeding in the middle of the night, every night. She was obviously an infant. And 3:00 in the morning, house is quiet, father-daughter time. I was like, man, this is cool. Because for any parent out there, that father-daughter bond is really something special. At least it was for me. And it was cool until I realized, Ken, you're an idiot. It's 3:00 in the morning, and this is the best time you can get with your daughter, because I was working so much at Deloitte. And I said, you know what, I got to change this. This isn't okay. Like I was really frustrated, actually, because I had done everything I was supposed to do. Your parents said, go to school, get good grades, get a good job, you're set for life. But unfortunately, now I just realized my whole entire family was going to grow up without me, and that wasn't cool with me. So it took me about a year and a half, and I went to all kinds of apartment association meetings and did my, you're going to laugh, I'm dating myself again, Carlton Sheets, no down payment system, right? That was the only thing that existed back then. He did single family houses, but I was just grasping at anything I could find to learn, because podcasts like this, training programs, none of that stuff existed back then.
That's right.
Went to the apartment association meetings and just tried to network with all the speakers and learn as much as I could. I ended up buying 3 properties. Like my first one was a 28 unit building, then a 24, then a 22 unit building. Sold them 3 years later, made $500,000. And that was just incomprehensible to me, right? I just made more money on the side doing real estate than I did up until that point at Deloitte. So obviously I said, this is something I need to keep doing. And so I kept that. Remember, I was working at Deloitte still at the time, stayed at Deloitte for another year and a half, and then ended up leaving Deloitte, bought the Cessna Pilot Centers while I was doing real estate, bought 3 Cessna Pilot Centers where I learned to fly, and owned that for 3 years. And grew it up, learned a lot about running a decentralized business, under the FAA's inspection requirements and all that stuff. It was quite an experience. But again, all this stuff, as it turns out, has just been really preparing me for what we do now. And that is real estate is very decentralized, right? That's pretty fair to say. Properties are all over the place. And I became a numbers guy. I understood debt. And, this is all I do now. We sold the Cessna Pilot Centers a number, along back in, I think it was 2003 or something like that. I don't remember now. But now this is all I do. So that was a very long story, but that's how I got into multifamily real estate.
No, it's an interesting story, and it is kind of funny how sometimes we come to those realizations. And it sounds like you came to the realization about the time with your daughter, kind of early on. She was still an infant. I dad of 2 daughters. I actually just had one surprise me. I didn't realize she was going to stop by. She's normally about 6 hours from here, so
okay.
that was kind of nice. But yeah, you don't get that time back. I too worked quite a bit when they were younger, and you just don't get that time back. So when you had the Cessna Pilot Centers, it sounds like you were maybe more self-employed as a business owner then, and maybe had a little bit more time to be able to spend with them.
With the kid? Oh yeah, absolutely. Yeah, here's what's important: you get to be in control of your time. When you're working at a large firm like Deloitte, look, I'm not knocking Deloitte. As all the CPA firms go, they're a really great place to work.
For sure.
You're being managed by other people. You don't get to come and go when you want to come and go, right? I mean, you get to work at 7 a.m, you get home at 11 o'clock at night. I mean, it's just, and there's nothing you can do about it, especially when you do M&A work. Because when you get the call, hey, we're doing a deal, like you're dropping everything and you're going, and that's just the way it is. That is what was important to me, is that I now became in control of my time and I didn't have to report to someone else other than my family.
Yeah. But it sounds like that too was key. Like you said, it really kind of lends itself to what you're doing now with the multifamily, being able to kind of look at these mergers and acquisitions and all of the accounting work that goes along with that kind of mirrors up with some of the financing, the due diligence, the different things that you have to look at for the multifamily. So that's great.
You can see it all kind of fed well. Yeah.
Yeah. Let me just curious more than anything else. So, you sell these apartments, make $500,000. You decide what led you to deciding to purchase these Cessna Pilot Centers. Did you have previous aviation experience? I mean, what was the
kind of? Let me tell you, and nobody believes this, but this is really what happened. When I was working at Deloitte, it was downtown Cleveland. We were in Key Tower, 23rd floor, and I could see out my window Burke Lakefront Airport. And I don't know, I just thought, man, it would be cool to learn to fly. I just thought it would be cool. So on my lunch hour, I would drive to Burke Lakefront. It was literally 1.5 miles away from my office. What CPA goes to lunch and goes flying around an airplane, lands, gets back, and comes back to work, and nobody knew what I was doing. But so that's how I got to experience the flying thing. And so at the time, the Cessna Pilot Center at Burke Lakefront, they had like 13, 14 airplanes. Only one of them was new. And of course, I'm flying the new one. I'm not flying the 30-year-old airplane. And I thought to myself, this place seems to be doing well, but nobody wants to fly in airplanes with shag carpet, and they just don't, right? So I
Right.
thought, what if I bought this thing, and I didn't pay much for it, because the guy that owned it was a pilot. All he wanted to do was go fly, fly, fly. I get it, and I was only a private pilot. I said, what if I bought this thing and turned all these airplanes over and made them all new planes? I bet a lot more people would want to do this, and I wasn't wrong. I mean, I absolutely blew up. But here's what's interesting. So that was May of '01. I think it was May of '01 when I bought it. What happened in September? 9/11. So there is something there. So think about this, right? You just turned over your whole airplane fleet. You own a bunch of airplanes that need customers to help pay for them. And we couldn't fly for like 4 to 6 weeks. It was
Jeez.
definitely a stressful event. But as it turns out, marketers say any PR is good PR, and they weren't wrong in this case, because the paper at the time was called The Plain Dealer, and they would do entire full-page articles, pictures, everything about why people learn to fly privately, right? Because remember, everybody wanted to fly privately, so you didn't have to worry about, having a bomb on your airplane, right? And so our company just grew like crazy. We were selling airplanes, teaching people to fly. You can't buy that kind of advertising. I mean, in front section of the, one of the sections of the paper, and it's literally full color. I mean, it was just nuts.
Yeah.
So that's how I got into aviation. It taught me so much. I mean, we got hooked up with the Delta connection. We were training pilots from zero all the way to the airlines. That's pretty exciting. The FAA, it's called a Part 141 school. So it's a certificated pilot school, right? And so they come at every airport, inspect our airplanes, inspect our processes, check our flight instructors, all that stuff. But what it did is it really got me very disciplined about how to run a business that's decentralized, right? Because the FAA, they don't care what airport your plane's at. They're going to inspect it. You'll fly to, I don't know, Columbus. Well, it just so happens the FAA office in Columbus said, I'd like to inspect your airplane, right? So it taught me so much about what we use now: checklists, systems, processes, redundancy, all the stuff that you should do when you're running, 1,500 units all over the place. You've got to have a good system.
Yeah, for sure. No, that's really neat. Do you still fly today by chance?
I don't. Yeah,
Okay.
I don't. So it's a single engine airplane thing. I'd rather have two. And the reality of it is, flying can be very dangerous if you don't do it all the time and stay very good at it. I mean, you just have to. It's a very unforgiving thing, as you can well imagine.
Yeah, for sure. For sure. Well, let's maybe talk about it. Well, so you did those couple things, and you'd already experienced multifamily, buying some smaller apartments, and still decent size. I say smaller, decent size apartments. So you bought the first two, you sold them, you made the money, and then where did you go from there? Bought more.
Yeah,
Okay.
we just kept buying more. Actually, I ended up partnering with somebody that I had met at one of those really boring apartment association meetings. Super nice guy. He was an attorney, did a great presentation, and we just developed a relationship. And he's like, "Hey, you want to do some deals together?" And we had a good match. I mean, it was a long career. We still own one property together. He's since retired. Super great guy. But he helped accelerate that because he had a lot of experience and probably at the time more money than I did. Things like that. So yeah, I just kept, kept buying. I think the next set that we bought was 5. We bought 5 at one time. 5.
Oh, wow. Okay.
Yeah. I mean, I couldn't have pulled that down by myself. I needed a guy like him to help me.
So were you guys joint venturing then on the ones that you started buying together? Okay.
Yeah. Yeah. And then eventually, after I was very comfortable, remember I was familiar with the private equity model, right? Where you private equity firm puts some of their own money in it, but they raise money from outside. So then we started the syndication process and syndicated a few deals together. And he's retired now, so we don't do new deals together. But I eventually, so about 15 years ago, we decided, you know what, Cleveland's great, but it's not a good demand supply setup, right? It's the opposite of the way you want it. And so I thought, man, if we can make money here, imagine if we went to a place where people really wanted to live. Imagine how well we could do there. I wasn't wrong. As it turned out, I was dead on right. We've been in Florida since. We don't have anything in Cleveland anymore except my back office and my home, of course. But everything we do is in Florida, and we now have, what happens when you're in this business. You do deals with your own money, then you turn into a syndicator, and then if you continue, oftentimes you'll become a fund manager. So what happens is syndicators go find the deal, then raise the money. Well, if you've ever done that, that's massively stressful because you got money to raise in a very short time frame, and you better hope you've got a good pipeline of investors, right? Well, we decided enough of that. Plus, it was hard to find a deal, right? Every other person you're competing with, they're all syndicators. Well, so we flipped it around, and I said, let's go raise the money first and then go find the deal. And that's what we do now. We've been doing that. We're on fund number 4 now. And so now we raise the money. We've got about $15-16 million that we're trying to deploy right now. But now, obviously sellers, brokers, everybody takes you a lot more seriously when you have money in the bank.
Yeah, for sure. Ready to deploy.
That's right.
And for the audience, maybe kind of explain the difference there between the syndication model and the fund model. I mean, you pretty well laid it out, but just kind of a little bit more in depth as to, obviously syndication being a single property that you're raising for. And you're going to have some of your own capital in there, but you're raising capital for limited partners who will be involved with it. But from there, when you start looking at a fund, how many properties are in a fund? Kind of explain how that works, if you could.
Yeah, it could be however you want it to be, right? The thing about syndication and funds, it's whatever you want it to be, and that's the reality. So fund number 1, we put 3 deals in, a deal in Tallahassee, a deal in Daytona, and a deal in Bradenton. Fund 2, right now we have 1 deal in it. We have some of the funds that we haven't deployed yet. We're just trying to find a deal for that. So we have a little bit left in our fund number 2. I'll tell you why I skipped number 3. We have fund number 4 that we've raised money for. So we've got $15-16 million to deploy right now between those 2 funds. And so now our 2 funds will be partners, right? So it doesn't matter. That's kind of stuff doesn't matter. What matters is investors like it because you usually put more than 1 deal in a fund. So you get a little diversification. Number 2, most people that do funds are a lot more experienced because you're asking me, or I'm asking you to give me your money, and you don't get to bless the deal, right? You got to vet me and my track record and make sure that I do what I'm said I was going to do, and that's what we do. We wouldn't mislead our investors. So we went to that fund model because it became really hard to find deals, and it's just really stressful in Florida. If you're a syndicator and you go after a deal, a good deal in a nice neighborhood, you're not the only person looking at it. There's probably 15, 20, even more offers. Well, how do you differentiate yourself? You got to pay up. And you somehow got to convince a broker, Mr. Broker, I promise you I can raise the money. I don't have any money in the bank yet for this deal, but I know I can raise $3 million, $4 million, $5 million, right? And can be a very hard challenge. Well, now sometimes if you're not, if you haven't done a lot of syndications, remember I said you got to pay up? Well, you got to pay up enough that the seller and the broker are like, okay, we'll take a chance on you, right? Because it's worth it, right? It's worth it. And that's how the syndication thing works. It is a very stressful way to buy. If you haven't done it, it's stressful because you're going to go find this deal and you really only have 45 or 60 days to raise this money. And the seller is not going to be very kind to you if you can't close. I mean, it's not a pretty situation for you. So we were okay with doing it that way, but I didn't want to have to keep paying up. And I don't like that stress. I mean, that's very stressful. Probably half of the hair is gone from those syndications, right? It's just so much. It's easier to get a deal when you do raise the money first, but it is much more difficult to raise the money because I don't have a pretty building to show you. I have all the other pretty buildings I bought before so that you know what I do, but you don't have, okay, most of the time you don't have a building in front of you to look at. So you've really got to understand me, us, how we operate, what kind of deals we do. The trust factor has to be so much more in a fund environment. And, as it turns out, I'm not wrong. I mean, we get in just about any best and final round we want to get into because they know that we can really close. And we've got fantastic relationship with the brokers, right? Because we know they want to close. We don't want to make it hard for them. It's a give and take in this world, right? So we treat them really well, treat their sellers well, and we close.
Yeah. No, it makes sense. And what about from an investor standpoint? You're raising capital. Are you getting commitments, or are they actually putting money into something while they're waiting for you to close? And if so, is there any kind of distribution that happens while the money's somewhat on the sidelines?
Yeah. So again, the solution to this is all over the map. Everybody probably does something different. What we do, because I think it's the only fair thing to do, is they send us their money. It goes into our PNC high yield savings account just for that fund. That fund, last I checked, it earns 4.57% annual returns. All that interest gets credited to them. I don't take any of it. It just sits in there. And if they want us to distribute the interest, we'll distribute it. It doesn't matter to me. It's their money. And so now it's earning interest, right? So most people are indifferent as to whether they're earning 4.5% in their bank account or 4.5% in my bank account getting credit back to them, right? It's exactly 6 of one, half dozen of the other. But it's important to us because when brokers have to prove to sellers that we're legit, I can't just send them a bunch of signed subscription agreements. I got to send them a bank statement. Oh, okay, you really do have that money. Yes, sir, I do. Right? That's why that's important. And, when I approach how we structure everything, it's always got to be about the investor first. I mean, you can't, some people just say, hey, Mr. Investor, Miss Investor, you need to send us your money and know it's not going to earn interest and we'll deploy it as fast as we can. Like, I don't think that's fair, right? Because now I'm under severe pressure to deploy that money. And you and I probably know the worst thing you can do to any investor is get FOMO, right? You don't fear of missing out. You need to be disciplined as a buyer. That's what they pay us for. We don't get deals done as nearly as fast as many others, but it's because we're just very careful. We've been doing this 27 years, and we're just really, really careful about what we buy. If I don't buy another deal, my life will not change, right? Obviously, that's not my goal, right? We're here to be a business, but I want to do deals that I really believe are going to be good deals. And that's the level of trust you have to have with your investors. And you have to actually be that person, right? You can't some people just, I'm doing deals left and right. Well, I don't know why, because there are not that many deals out there right now.
Yeah. What about it? Still maybe staying on the subject of the fund model, just because I think it's interesting. When somebody does, so let's say, now you are putting their money to use. So we're taking down another property. Let's say now we've got 3 maybe in this particular fund. What are the opportunities? Or is this going to be an exit where we're selling this as a portfolio, all 3 properties? Or what does the exit look like from an investor standpoint, where they know they can definitely get in or get out at a certain point?
Yeah, so it could be a portfolio sale. Most likely it won't be. It most likely will sell them off individually. But what happens is, remember, you're investing in a fund. You're not investing in 3 individual properties, right? So you're investing in the fund, and in our fund, it works like this. Our fees are only 1% asset management fee, 1% acquisition fee, 1% disposition. Very little fees. We're not here for the fees. We're here for the 20% carry interest when we're all done. So in our fund example, this is where it really benefits investors. So let's say the fund is $15 million and I sell the first asset and it generates total of $5 million. The first $5 million goes directly to you, right? Well, let's pretend like I sold it for a profit, right? I sold it for $8 million, $3 million plus $3 million. I'm sorry, $5 million, what you had in that deal. And then you made $3 million in profit. Well, that whole $8 million goes back to the investors because they got to get their money back first before we get paid. That's how it should be. That's how our fund is. Deal number 2. So now they put in 15. Let's pretend like the exact same thing happens, right? I get 8 million, 3 million profit, 5 million from what went into the deal originally. The investors are gonna, what do they have? They have 7 million left, right? I've already given them 8. Now I'm gonna give them 7. And then that last 1 million is split 80-20. See, they've got their money back before we start to get paid. So that means we wait a very long time to get paid, but that's important, right? You shouldn't, we don't, like in a syndication, if they invested in 3 syndications, if deal number 1 did really well and the sponsor made a lot of money, but deal number 2 sucked and they didn't make any money, see, in a fund that washes out, you see?
Right.
You know how that happens? That's really important for investors to understand in fund environments. Now, not every fund structures it that way. We just do, because I don't think we're going to lose money on any deal. That's how I structure it. And I set this thing up so that if you do well, I don't need to worry about me. We will do well, right? So I just focus on you, take care of you, make sure you're good, because when you get paid, I get paid.
Yeah. Makes sense. And so those sales may be happening within the fund, or possibly refinances, depending on the lending environment. And then if somebody, is there a definite time when the fund closes out and all, money's just redistributed, or is this a kind of evergreen where just, you're holding on and getting residuals from rents and stuff for the investors?
Yeah, most investors don't like to make perpetual or investments in perpetuity. They just they just don't. They want closure. So, but here's what we don't do. There are some people selling deals right now because they started these syndications of these funds and they put definite end dates. Well, what if that end date is just happens to be when the market isn't very good? Well, now you just hurt yourself. Now you're selling, you got a gun to your head, and why would you do that? That just makes no sense, because you're hurting everybody, right? So our goal is 3 to 5, 4 to 6 years hold period. But if we need to hold longer, we can. Like, we have a deal, Arbors of Garden. It actually is a syndication. We bought it in 2016, but so I'll tell you why we haven't sold it. We raised 2.2. We've returned everybody's money. We've returned another $1.8 million. It still cash flows, and they have $5 million in equity. And I have $500,000 in the bank to continue to upgrade the units to make sure that it stays relevant. It's a 2001 property. It's 23 years old. You got to freshen it up, right? Now,
for sure.
Why would I sell that? You've got your money out a long time ago. You've almost got a double. You're still getting cash flow. You're like, if I sold that, I'd probably have a mutiny on my hands, right? See, that's an example where it doesn't make sense to sell. I mean, when you get a deal like that, you just write it as long as you can. Now, we'll probably sell it in 27, 28, but no investor has complained, because, those investments are great. That's how you build wealth. You get your money out and you go put it in another deal. And then you get it out and you go do it again. And next thing you know, you own all these assets and you got nothing in them. I mean, that's the best world. And then some assets it just depends on the asset, right? That's a newer asset, a great area, great floor plans, everything works. But another asset, maybe it's just a 3-year hold, right? Maybe I don't want to hold it a long time for various reasons. Maybe it's too old, maybe whatever it is, right? Whatever's going on in the market. So we try to hold them 4 to 6 years so that people know that there's end in sight. But I also don't, I don't have to sell at the end of 6 years. That's a disaster. Just never want to do that.
Yeah, no, it makes total sense. And I think that's a wise way to do it. So tell me a little more about you mentioned you take your time. You've got a very, very specific criteria on what you're looking to purchase. Are you still focused on primarily Florida, or are you open to other areas? And then tell me a little bit about your strategy and kind of what it is that you're looking for.
Yeah. So Fund 4 is devoted to Florida, because that's what we told our investors we would do, right? In my world, you don't tell your investors you're going to do one thing and then do another. That's never a good idea. But Fund 5, we will expand it geographically to more areas in the Southeast. Right now, we'll stick to the Southeast. There's plenty of properties in that region, but we love that region. So that'll be the plan going forward for that. What was the other part of your question?
That was pretty much it, whether you were going to be focused primarily, but what is your strategy when you're buying these properties? How many particular units are you typically focused on as far as a minimum, if there is one? And then, what strategy are you doing to build the equity for your investors?
Yeah. So typically we'll start at 75, 80 units, go up to 250, somewhere in there, right? It's got to be big enough for on-site management. So if I were to give you the elevator pitch, we're going to buy good properties in good neighborhoods. We're done with the bad neighborhood thing. That was no fun. We've done it early on. So good properties, good areas that are growing. They have to be growing. They have to have a diverse income stream, right? Diverse employment. I don't like being dependent on the military by itself. Nothing wrong with the military. It's just I don't want all my eggs in that basket. Same thing near Disney. That's another bad idea, right? So we care about that diversified income stream. And when we can buy it, when we go in close to even leverage, that means at a cap rate that's very close to our debt interest rate. That's what that means. And then 2 to 3, here's the key, the 2 to 300 in upside. We have to believe there's $200 to $300 in upside in the rents and not hoping and praying that we get it over 5 years. That's not what we do. What we do instead is we see that upside today. The next unit, when we close, my next unit I lease, I want it to be near my projected rents.
Okay.
Right? That means that I've got a gap today. See, I can count on that gap today. And then usually we budget out 2 to 3 years to get through that, right? To get there, because it just takes a while for leases to turn. And then after that, we budget 2% rent increases, nothing big. So in the nutshell, we're looking for even leverage, $200 to $300 in upside. And we know that if we do that and we execute on that, our target is mid-teen returns to our investors. That's their returns. So if they give us, $100,000 in about 5 years, they're probably going to get back 175, 180. Now, want to beat that, okay? But and we typically do. I can't guarantee it, but that's our target.
Yeah, makes sense. And on that $200 to $300 on upside on the rent, is that through doing updates, or is that just, maybe the prior owner or manager did not keep up with the market rents? Obviously that's an ideal situation if all you have to do is nothing and just raise the rents. But are you doing some upgrades?
Yeah, the reality is it depends on the deal. I mean, we've done one deal where we put in $3.5 million of upgrades. The Arbors and Garden Grove deal that I told you about, the one that we've held for over 8 years, our renovation budget was $50,000. Certainly nothing big. It was undermanaged. It was undermanaged, and all we did was spruce up the amenity section. Do the pool, pavers, all that kind of stuff, and it's been off to the races because it was so undermanaged.
Yeah, that's great. Yeah, those are nice. And so on the Florida, obviously, Florida's been in the news a little bit on a couple different fronts, right? Yeah, a little bit on the insurance side, and then of course the hurricane. So, are you still bullish on Florida as a state to invest? And tell me a little bit about how you've been able to navigate some of those challenges.
Yeah. So, and on insurance. So remember, there's a reason that I insist on 200 to 300 in upside, because I don't know what's going to happen next. Well, guess how you pay for massive insurance increases? With 200 to 300 in upside, right?
That's right. Yeah.
If you budgeted $50 an increase, well, now you're toast because you don't have enough new money to pay for the expenses. So we budget insurance. We budget that it's going to go up. Believe it or not, we just renewed a property. The premiums went down 25%. The insurance, it's recovered. I mean, it got brutal for 2 years. I mean, they doubled and tripled. It was brutal. It was because insurance runs in cycles, right? So when the prices get really high, everybody's like, oh my God, they're making money. The insurance companies all jump in, makes capacity huge. Now you've got more capacity than you have demand. Then prices come down. They speed each other up. It's a race to the bottom. When it gets to the bottom, you're getting everybody's losing money. So now they leave the market. This goes on like over and over and over. So they all leave the market. Now we have not enough capacity. Rates go way up That's what happened. And so it's cycling back down. The insurance companies, even with the hurricanes this year, it is they're very healthy in general. They've literally printed money for 2 years. I mean, a lot of it. And so
Right.
now, we're getting some relief. So you just have to budget it for it, right? And then with respect to hurricanes, I mean, you just have to be careful what you buy and where it is. Don't buy a stick frame constructed 1970s building on the beach. Like, don't do that.
For sure.
It's
Yeah,
not going to go well, right? But if you're going to, we never buy anything on the beach, but, close to the water, you want block constructed or you want brand new. We have a brand new asset in St. Pete that the last hurricane, St. Pete got 18 inches of rain and 100-mile-an-hour plus winds for several hours. Property lost a ridge vent and a fence, right?
Yeah.
Current building codes really beef these buildings up, right? So newer stuff always works very much better than older stuff. So you just got to be careful what you buy and where it is.
Yeah, makes sense. Makes sense. Tell me a little bit about over the last couple years, just and it would love to hear your perspective as well, just on the market itself. Are cap rates starting to?
They were. They were.
Yeah. Tell me what you're seeing out there.
Yeah. So I don't know when this will air, but a few weeks ago the Fed dropped rates 50 basis points. And that's cool. Everybody was looking forward to it. It was fully expected. Treasuries came down. And then a few weeks after that, guess what happened? All of a sudden we get a great economic reports with payroll way better than expected. Hourly rate or wages much higher than expected. A little bit uptick in inflation. Just positive retail. So everything is beating expectations. Now the market thinks, wait a minute. Maybe the Fed isn't going to keep lowering rates. So the Fed went down 50 basis points. The treasuries went up 75 because of those reports. So what's happening? Cap rates haven't come down yet. Rates seem to come down. Right now, the market's just locked up. It's locked up because sellers are only selling if they have to.
Mm-hmm.
And the ones that don't need to sell, they want to sell, but they're just not going to sell into a bad market, right? Like my Arbor's a Garden Grove example. Why would I sell that building into a bad market? That would be stupid. Yeah. So what's happening is when rates come down, and I think they will, I just don't know when they do come down, there's going to be so many sellers out there. It's going to be a buying frenzy because all they need, sellers don't want to sell at really depressed prices. They just need cap rate relief so that we can get buyers and sellers closer together. That's all. Right now, the sellers are like, no, I that's just too far off what I need to sell for or what I want to sell for. They'll give a little bit, but they won't give 25%. They won't do that.
Right. Yeah, that makes sense. And what about just multifamily in general as a investment for somebody who's maybe familiar with stocks, bonds, mutual funds? They've done their 401k. They're starting to hear that there's maybe these alternative investments out there. What about multifamily do you like, Ken?
I like it. Remember, I'm a CPA and lender by background. So when you think about that, forget about the flight school thing, right? I'm a pretty risk-averse guy. I just am. So if I can find a way to get 15, 20, 25% annual returns for investors in a relatively low-risk asset like multifamily, like I can't figure out how to make people not need a place to live. If they don't need a place to live, investments are the last thing you're worried about. I mean, this is a basic need. People need housing, and there's an overall shortage of housing. So I don't see it going away. I will tell you that I don't do the stock market anymore. I can't stomach these, the CFO of this company had an affair with his secretary, so the stock just plummeted in half. I'm like, stop. I mean, that's just ridiculous. Who cares, right? It has nothing to do with it, but it's what the market does. It doesn't happen in real estate, right? It just doesn't. You have real assets there that serve a real purpose, and it's generating cash flow. And it's based on a basic need, right? It's probably not going to go away. So as long as I can improve that cash flow of that property, there's a pretty good chance somebody's going to be willing to pay me more for it, right? It just makes sense. And don't forget the tax benefits, right? Whether
For sure.
passive or active, you still get some tax benefits. So it's hard for me to find another asset that gives you a little bit of cash flow and allows you to grow that cash flow so that you can grow the asset value, right? You're storing your money in that investment that's giving you something back. Like, think about this. How many stocks pay 5-6% dividends and are growing? They're very few and far between. Private equity does the same thing, but you don't get cash flow on private equity deals. When private equity firms buy a business, they're going to invest in that business and grow it, and you get paid when it sells. There's no payments in between, right? There's no regular cash flow distributor. Typically not. Maybe there might be, but usually there's not. And you have the risk that company's value can go to zero, right? The company could just really be run into the ground. I don't know how often it happens. I remember at Deloitte, it happens, right? It does. It's rare that multifamily goes to zero, right? It's just rare. It's not impossible, but it's far less common. So I just like to take care of the downside. And who doesn't like relatively low downside risk and 15% annual returns?
For sure.
That's why I like it, because it's boring and less risky. I can't say safe because you can never say that word, but it is less risky, I believe.
Yeah, I think so too. And maybe let's talk a little bit about leverage on these. So typically, Ken, what type of a debt structure are you doing when you're doing a multifamily acquisition?
Yeah, right now we're targeting lower leverage because debt's the problem right now. Debt is harder to get. So we're 50-60% typically is where we'll be. In terms of term, we don't do variable rate stuff. I just don't. That's how people got in trouble. People that are in trouble right now, they did bridge loans. We did a bridge loan, but I got out of it as fast as I could and put agency debt in place, right? So we always I like 7-year debt. Because if I'm going to hold 5 years, I'll pay a little prepayment penalty. That's okay. To have that little buffer, right? If I'm targeting 5, let it give me 7. That gives me a time to make a good decision. So it's generally longer term fixed rate debt, because if the deal works at this rate, then I'm good, right? I don't need to hope and pray that rates go down.
For sure.
Hoping and praying never works, at least not for me.
Yeah, I understand that. What are some other things that you think maybe differentiate KRI partners from some of the other folks that are out there, offering similar multifamily type?
Yeah. So here's what sets us apart. I need you to be patient. I'm never going to get FOMO. We're going to just do solid, boring, good deals. That's what we're going to do. And know that I'm always going to dive into the details. Every business is about the details. So if I were to say what sets us apart generally, we're vertically integrated. So we self-manage.
Okay.
Why? Because I believe you're going into a business. This apartment thing is a business. It's not a duplex. It's not a single family house. It's a business. And so if you're going to get into a business, you need to know how to run that business, right? That's what I believe, because you're going to get better at it over time. And so now after 27 years, look, we're not perfect, but we've gotten a lot better at it. And now it's hard for me to imagine finding someone that's going to care as much as me and our people, and that that is going to do as good a job. I just have trouble thinking that. So the vertical integration, I think, separates us. The discipline, I know, separates us, because there's a lot of people who need the fees to survive. Yeah. Our fees are 1%. That's as low as I don't know of anyone who's below 1%. So all I need the fees for is you just keep the doors open. I'm here for the carry interest, just like you are, right? You should want long-term appreciation. That's what I want. We're lined up perfectly. And I don't care about the fees. The fees are not relevant to me. I need them to do what we do, but that's not how I make money. And a lot of people approach that very differently.
Yeah. No, that's a great point. And when you say vertical integration, obviously I know what you're referring to, but for the audience who maybe doesn't understand exactly what that means, because I think that is important. It's not always possible with certain, the way certain businesses operate,
Right.
but I do think it is. You just have a level of control when you've got that you just don't have otherwise. And so, can you maybe explain what that means from a property management standpoint?
Yeah. So we manage our own properties. That's what vertically integrated means. Here's what happens. We've done third-party management. We do still a little bit, but we don't take on any new clients. It's just too hard a business. What happens when you're working with a vendor? That's what a third-party manager is. They're a vendor of yours. And what happens is they're going to manage the message that you get as the owner. They're not going to hopefully not lie to you, but they're going to massage it. They're going to, they don't want to be fired. They want you to keep them around, and they're going to help manage that relationship that way. Well, in my world, I go directly to the maintenance guy. If I have a maintenance question, I go directly to the property manager. There's no filters. There's nobody that stops me from seeing and feeling and hearing. And we built this entire company. Every single resident that lives in one of our buildings we call it our Take It to the Top program. It sounds kind of cheesy, but if there's a problem, those tenants know. They get right to me. Nobody gets that email but me. And you see now, is that going to happen in a third party? No. There's zero chance a third party manager is going to let the owner get emailed directly. It's never going to happen. Now, having said that, I don't want to poo-poo the whole third party management world, because if you're good at managing the third party managers, and there are some very good third party managers out there, you should utilize them, right? I don't want anyone to think that you shouldn't ever use third party management. I'm just telling you that if you're going to be in this business long term and you want to raise a lot of money and do all of that, you really got to understand this business. And in my mind, there's no better way. I'm going to still have the same headaches managing a property that I have if I'm the manager. We manage it ourselves. I'm going to have those same headaches if I'm managing the property manager, the management company. I just am. I'm just going to have one person to yell at with them. Whereas here, I can get right to the real source of the problem and fix it, right? Everybody thinks I don't want that headache. Well, we have, 45, 50 employees. Many of those people are on the ground running our properties. So I don't deal with a lot of those issues because I have people in place below me that do a fantastic job. So that, again, I don't want to discourage anyone. If you don't have the time to manage your own property, nothing wrong with third-party management, but boy, you better be prepared to actively manage them, because they can destroy your deal if you let them. Because every business is successful because it executes on the business plan. So 2 types of people that are in trouble right now. 1, the person that didn't manage their debt properly. And number 2, the person that didn't execute on their business plan and get that $200 to $300 of rent, which is what they should have got, because they would have had the money to take care of whatever they needed to take care of. Does that make sense?
It does. Yeah. Fantastic. And Ken, if people want to find out more about you, they want to hear about the deals, the particular funds that you have coming up, how can they reach you?
Yeah, go to kripartners.com. kripartners.com. And then what's going to happen when you get to our site, we do education as well as investing. Our business is set up to help people create wealth through real estate. If you want to do your own deals, we can help you. We'll teach you everything that we do. If you're like, nope, I have no interest in doing that, I want to be passive, well, you can look at our funds and then, passively invest with us. But we're set up to help people create wealth through real estate. That's what we've been doing for 27 years. So again, kripartners.com.
Fantastic. And Ken, I have 2 other questions for you that I ask every guest. So one would just be somebody who maybe is just starting out in their investment journey. What advice would you give them?
Yeah, they need to do 2 things. The first is they need to dive into the numbers and legitimately understand the numbers. Please do not underwrite at 30,000 feet. It doesn't work. It works for me because I know what's going on the ground. But you're in the beginning, you don't know what's going on. You've got to get into the weeds, understand the weeds, then you can go up to 30,000 feet, right? So that's number 1. And number two, don't be afraid to do the work. You got to go out. You got to tour properties. You got to call brokers. I mean, you got to do all this stuff. You got to legitimately do it, because so many people. I always quote my buddy. No, he's not my buddy. John Maxwell, right? If you've heard of who John Maxwell is, I heard him recently. He said something. Everybody wants to do what you do, but they don't want to do what you did. Think about that. And that's the mistake that everybody makes, because they see us now, right? We've raised $45 million. We've done very successful. They're like, oh, this is easy. No, it wasn't easy. It took us 27 years to get here, right? You have to do what I did. If you do what I did, then you'll be able to do what I do. And that's the thing. I just want people, just roll up your sleeves. It's a business. Think of it that way. If you do, you'll rock and roll. You will kill in this business. If you don't want to do the work, if you don't want to learn the numbers, you will get destroyed in this business and lose a lot of money. You just will. And I don't want to see that happen to anybody.
For sure. No, I think that's great advice, Ken. And how about a book recommendation? Doesn't have to be real estate related, but it certainly can be, just something that's been impactful that you've read.
Yeah, I read a lot. Probably one of the most recent couple. The E-Myth Revisited, John Grisham. I think it's Grisham, right? Yeah, I think that's who wrote it. And then another one I always liked is 7 Habits of Highly Effective People. Has nothing
very good ones.
Real estate. But everything we do in life is about relationships, and Stephen Covey wrote a lot about relationships in that book. So those are 2 books that they're non-real estate, right? You can find real estate books.
Both of them, yeah.
But, those are 2 that have shaped me in a really big way.
Yeah, absolutely. Well, Ken, this has been fantastic. I've really enjoyed our conversation today, and thank you so much for being on the Wealth Flow, and I think we'll call it a show.
Sounds good. Thanks so much for having me.
Yeah, absolutely.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.